Hey everyone, it's December 19th, 2015. Before I give you a rundown of this week's video, I want to remind you of two things. First, this will be the last weekly video of the year and the month of December. I've also posted the second and last blog entry for the month of December, so make sure to check that out. I'll be back to posting weekly videos on the first trading week of the year, and as I've commented before, starting in January, I'll post two blog entries every month. Um, the second thing I want to touch base on is that we're currently working on possibly extending a new service for day traders. Essentially, how the program will work is that for those interested, you would pay a small fee to access the day traders live chat room. While in the chat room, you'll get to see that not only will you get day trading ideas that I'm personally looking to implement, but you'll look to see how I implement them and why it is, or what it is that I chose to trade, and what I'm ultimately expecting out of the trade. If this new service is launched, it will be launched sometime in the first quarter of 2016, and it'll be in corroboration with hotstockmarket.com, which, as you all know, it's the only financial message board where I post my comments. To that end, if you haven't already visited hotstockmarket.com or haven't enrolled, remember that's completely free, and really you get to share a bunch of great trade ideas and whatnot with like-minded investors. The people that usually post here, or they're very helpful. They'll do their best to sort of help you navigate the site. If you're a new investor, there's a section completely dedicated towards explaining the basics of charting to how to avoid pump and dump schemes and so on and so forth. So it's really a great community. Like I said, the people here are really friendly and they're willing to help. While here, make sure to check the SmartStocks thread, which is essentially the thread where I post all weekly videos and blog entries, in addition to other commentary that I have about markets and the economy. So, like as I was saying, this third service, if it's offered, it will be offered in the first quarter of 2016, and it will be in collaboration with HSM. I'll let you know the details the closer we are to launching the service. But as of now, we're sort of calling out for interested parties to see how many people will get involved. To really get this going, we need at least 10 people. So far, 3 people have expressed an interest, but I suspect that number is going to grow over the next few weeks. Um, on the matter of performance, assuming we don't close any other trade before year end, stock and option trades have netted investors with an average 2.7% return, whereas the S&P 500 over the same time period has netted investors with a 3.8% return, 3.8% loss, excuse me. So all factored in, we've outperformed the index by roughly 6.5%. Again, these are not stellar numbers, not great trading results, but they do show that the fact that we were able to eke out a small gain for the trading year shows that the system is in fact effective, and that there is a way of making money in the markets. As some trends normalize going into 2016 for specific sectors and individual names, we believe those trading results are going to be enhanced mightily next year, and that's namely because the trades we offer are namely sync trades. So we depend on a steady trend to really sort of make the most out of every trade. So you've been interested but haven't yet joined, send me an email at smartstocks8@gmail.com, and I'll be more than happy to extend a 7-week free trial. Lastly, on the blog, I won't spend much time discussing it. If you're interested, you're more than welcome to visit the website and read the blog post. But essentially, I compare the price performance of the DAX in 2014 versus that of the S&P 500 in 2015. And to sort of drive home the point of how important it is to sort of focus in on single inputs rather than from the very beginning focus in on different factors and different inputs. It shows you that the power of observation. Just briefly, the time I've spent talking to traders or exchanging ideas or whatever it may be, I noticed that many of these traders tend to put off observation or they omit it altogether. And that's omitting observation is perhaps one of the biggest pitfalls any investor can, can make. Science and starts and ends with an observation. If you don't first observe what it is you're trying to analyze or interpret or it may be, you're not going to make any sense of it. And if you can't make any sense of it, more likely than not, you're going to end up making a mistake in the trade. So the importance of observation is very important and very beneficial when it comes to trading. Again, making something, sort of wrapping around a meaning around what it is you're doing. Part of the reason why I'm so engaged and sort of so enthusiastic each day of trading markets is because I know that each and every day I'm going to learn something new. A day doesn't go by where I don't learn something new about the markets. Whether it be when I read an article or do my own research or whatever, or just like I said, observe markets. And that thrill I get, that sort of rush I get when I trade and when I learn new things, is really what keeps me engaged. So if you really want to make this, even if it's a hobby for now, but you really want to make this work for you longer term, and if you want to see it and treat it as a long-term investment, then you have to again sort of wrap around meaning to what it is you're doing, and it starts with an observation. So that's really all I want to say about the blog post. If you want to leave a comment, make sure to drop a line at the bottom end of the section. And lastly, on subscription, for two subscriptions, the stock trading service and the stock trading service and monthly market report, the price difference between the two is only $10. The stock trading service is a Monday through Friday service where I share with you 4 different trade ideas I'm looking to implement that week. Each trade has its own its set of parameters, such as entry price, target price, stop loss, the risk I've assigned to the trade depending on internal and external factors, meaning depending on how I set up the trade relative to the market environment we're in, the type of trade, and the percentage of capital you should allocate to each trade. And then each day I send you sort of a brief synopsis of why I picked the trade, why I like the trade, and what I'm expecting to come out of the trade. And then on Fridays is sort of a recap of everything that happened in the week. Trades we closed, trades we opened, trades we still have a position in, trades that will be abandoned, and so on and so forth. And then the other service, the stock trading service and monthly market report, which again, it's only a $10 difference. It's basically the same service, the Monday through Friday service, but you also at the beginning of each month, on the first, you'll get you'll get more context into what the markets did that month. I'll cite different events, important events that happened that month. How they're essentially shaped price and how what all that means going forward. So if you're someone like me who's interested in not only making profitable trades, but also interested in understanding markets for what they are and sort of again putting meaning to what we're doing and growing as an investor, educating yourself and whatnot, then this is the service for you. So I hope more of you join. I look forward to working alongside you. And like I said, I'm extending a 7-week free trial, so just make sure to subscribe. So onto the charts. As I go through each chart, I'm going to give you what happened this week, sort of a brief overview, and what I'm expecting in 2016, bigger picture. So the fact that the S&P 500 closed below the lower time range this week and is sitting at a critical junction, which should not be labeled as support, not yet at least. Again, one should have pared down risk, or if you're really comfortable with the trade you have on, understand the limitations to the trade. If you notice, the S&P 500, once it came back up from the October lows, the S&P 500 not only traded back above the midway point to the established trading range, but it also spent a considerable amount of time trading in and out of these time ranges. The fact that the S&P closed the day yesterday, Friday, and the week below the lower time range for the first time opens the possibility of lower support currently priced between 197.01, 198.06 spiders of being contested. That's really the last big support band to the current range. If that gets taken out, then the S&P will retest the current lows at 1880. The problem with that is that notice how there was a slingshot move every time we contested that 1880 mark on the S&P 500. In other words, buyers quickly stepped in, paid a higher price, and then short covers sort of exacerbated the trend and covered higher prices. I fear that if the S&P 500 does in fact take out the last support band at 197.01, 198.06 spiders, that not only would it lead to a retest of the current lows, but could lead to a more significant imbalance, and that could not only impair this year's returns, but again, sort of start next year on a weaker foot, which is not not what the most desirable outcome for market bulls. Only a trade back above 2045 or roughly 204.73 spiders would sort of induce me to feel more comfortable about the current trajectory of markets, and but B also make me want to take on more risk, or at least be more risk oriented. Right now, again, unless you feel comfortable with the trade you have on and understand the limitations to that trade, you have to be very careful. I would only add to the trade to the upside on a confirmed break above the current 52-week high at 2132. But again, it's still a wait and see type of market. So for 2016, my expectations, broadly speaking, I think it's going to be a 5 to 7% year return on the S&P 500. So I think from year to year end, I think it's fairly reasonable to expect the S&P 500 to close at 2045 or thereabouts. So if you could possibly make 2% from here to year end. I wouldn't necessarily categorize that as a Santa Claus rally, simply because even if we get a 2% rally from current prices to year end, we're still going to be trading below where we started in the month of December. So it's a Santa Claus rally, and then it isn't. It depends on how you want to look at it. But going into 2016, the 5 to 7% return on the S&P 500 is based on a closing price in the S&P 500 of 2045. So that would roughly, we're talking roughly a close of anywhere between 2150 and 2175, 2180 for the year. If you look at most investment banks, the consensus is for the S&P 500 to end the year 2200. So I'm basically right in line, slightly below consensus. Do note, however, that if you look over the last 10 years, the price consensus investment banks have been dishing out for their year-end target prediction has been wrong 7 out of the last 10 years. I'm not here to bash these investment banks or how wrong they are or how right they are, or whatever it may be. It's just sort of it's a way of me showing you that these people more often than not can, or these calls, not these people, these calls more often than not can be wrong, and my call could just as well be wrong. That's the point I'm trying to get across. But so broadly speaking, by the end of the year, I think 2045 is a legitimate and realistic objective. And then next year, 2150 to 2180 is where I'm looking at S&P to end the year. On an individual basis, sector specific, and specifically, like I said, on individual names, there will be more pockets of opportunity. For oil, again, oil remains in a confirmed long-term downward trajectory, and it's very hard for one to get bullish oil unless we get a trade above 1140. Again, for me to sort of want to place a trade in oil long, and I would need to see the USO trade above 1140, 1150. That represents roughly 36, 37 WTI. But do bear in mind that the structure of the trade will still be negative or weak, and that would only change with a closing above, sometime in 2016, above 1423 USO, which equates to roughly $44, $45 WTI. Now, if you're someone who is okay with taking on a bit more risk and wants to sort of try to see if you can peg a bottom in oil, you have to understand that it's a risky business, and you have to manage your risk appropriately. If you want to do this, one way you could possibly do this, and this applies for anything, every time you're trying to play a reversal in trend, whether it be on the lower end or the upper end of the chart, whatever you're looking at trading, one way is to sort of say, okay, I think 1070 based on my analysis, and please realize this is based on actual concrete analysis that you've done yourself, and you think a particular price point may represent a good entry point for whatever reason. It's not as though you're picking random price points and just saying, let's see what sticks and what doesn't. This is not what this is really sort of aimed towards. But say if you think 1070 for some reason, and USO offers a good entry point, so you buy and you have you're considering investing $10,000 in a trade. So you say you put $10,000 to work at 1070, and you say, all right, I'm going to give myself 2 to 3% in leeway for the trade. So you buy at 1070 the moment, and you put a stop loss at 1040 to 1045. So the USO trades below 1045 or 1040, you're out of the trade, and you take on a $200 to $300 loss. And say you do this successfully, in succession, right, for 2 or 3 times. And again, the first 3 trades you do it, they turn out to be losses. So you're staring at a paper loss, or at a realized loss actually, of anywhere between $600 to $900. It's not great, but you understand it. The point I'm trying to get across is that you understand that by keeping the number of occurrences up and keeping losses small, this strategy, while it might not be offer the best probability or the highest probability of success per trade, it will offer the highest probability of success on the trade. So in other words, you could place, if you're trying to pick a bottom, and you place 1, 2, 3, 4, even 5 losing trades, but you keep your risk contained and you keep your level of occurrences up, then once the trade goes in your direction, right, you gain full command of that trade, and that's going to change the entire dynamics of the trade, because it's going to change your perception towards the trade, and it's going to change also, believe it or not, how you're going to approach the trade. So and not only that, but you also have room to operate. In other words, you have more leeway where you can dictate where you want to take profits, where you want to add to a position, where you want to trim a position for a smaller loss or for a bigger gain, whatever it may be. Because again, you're in a position where you're able to take on more risk, but whatever you do, whatever happens, you're still, if managed properly, of course, you're still going to be able to eke out a gain in the trade as a whole. So say the USO doesn't bottom to, I don't know, $10 USO, right? And this is your fourth attempt, so you're staring at it, $1,200 loss, and you buy it at 10, and then all of a sudden the trade starts working in your favor, and it goes to 1020, 1030, and you begin to trim positions at a certain price point, add another, and then a month later or 2 months later, the USO is trading at 11. So now you're staring at 10, if not more, depending how you sort of accommodated the trade all along. You're staring roughly at a 10% gain. So a 10% gain on obviously a smaller balance, 8,700, will yield you $870. So that basically one-to-one offsets, in large part, the losses, right? But again, if once the trade goes in your favor and you begin to position yourself accordingly and begin to sort of add or take positions as you go along, then that 800 is slowly, and believe me, it's slowly going to sort of build up to a 14, 15, 16, even higher $2,000 gain over time. And believe the math will work out. You'll come out with a gain. It won't be a stellar gain unless, of course, the very first time you place a trade, it turns out to be a winner. But you'll eke out a gain. So in something like that, if you're interested, if you're sort of a contrarian investor, that's a strategy to possibly pursue in oil if you like oil for one reason or another. My expectations is oil will remain lower for longer. In 2016, this new paradigm we've entered has oil pegged at the very high end, longer term that is, at 65. I think 2016 is going to be a good year for oil. Oil could actually post a 9, even 10% gain for the year. But bear in mind that, say crude oil ends the year at $35 a barrel, roughly. A 10% gain between now and the end of the year next year is only $4, roughly, $3.50. So that means WTI closes at 39, maybe $40 at best. Still going to be a lower, or still, still considered to be trading at a very low point, even with the possible 10% gain for the year. So that's really what I'm looking for crude oil. Like I said, the only way I would get interested, we're willing to take on added risk, is on a trade above 1140, 1150 USO for a possible trade back up to 1250 or 12 and change. As for the euro, unlike the S&P, which coming off the lows, it went back or proceeded to test the upper end of its trading range. Notice that the euro pierced but never actually closed a day, let alone a week, above the midway point to the established range. This not only speaks to the internal weakness of the trade, or not the trade, it speaks to the relative strength of the trade, but speaks to the internal weakness of the euro. And but like I said, until the euro trades below 107.81, that's where I would really sort of add to a position and or begin a position and add. I would only add to a position on trade below 104.61. Um, Again, 2016, my projections is I don't think the euro hits parity against the dollar until the fourth quarter of 2016 and leading into the 2017. It's going to require some time, but I just don't think don't expect the euro to trade or to spend a considerable amount of time trading above 114 if there's going to be some strength coming over the next few weeks out of the euro. Um, Sector-wise, consumer staples continues to act okay, even though every time a new high is made on an intraday basis, it quickly gets reversed. In other words, whether it be for the week and most certainly, whether it be for the day or most certainly for the week, those highs quickly get rejected or sold into, and price either ends uh, below the former 52-week high or at the low end of that week's trading range. And that again proves that the market has changed from being a buyer's market to a seller's market. A lot of people think that started at the beginning of 2015, and that's not the case. It really started at the beginning of 2014 when biotech and social media stocks created a blow-up top. Back then, that's when Chairwoman Janet Yellen said that valuations of these biotechnology and social media stocks were getting a bit out of whack. So really, back then is when we began to see a change in trend. Again, from being a buyer's market to a seller's market. But even so, XLP remains okay. The higher and the longer XLP remains by above 50.84, the better the chances for a trade up to 52.83. If you're looking to trade a possible breakout coming off this consolidation phase, what you have to recognize is that you're aiming to trade something like this, like the move we got in 2013, where once we consolidated for 5 to 6 months, it led to a 4 to 5% move coming off those highs before a new sort of cycle was priced in. Whether that new cycle going forward leads to more consolidation, a pullback as we saw back in 2000 and early 2014, or a continuation of the rally remains to be seen. But that's something to certainly keep a close eye on. Technology and other well-performing sectors very similar to the XLP. Here, as long as price holds above 42.05, but more importantly 43.74, it could lead to a measured move up to 45.28. Same sort of a strategy as the XLP. Lagging sectors such as industrials, it's okay, but again, if you were to break below 51, not only would these lows get retested, but again, similar to the S&P 500, the most likely event is that, unlike the last two episodes where we saw a slingshot type move where buyers quickly stepped in and pushed the markets higher from a critical junction, that being 1880 on the S&P 500 and 49 to 50 on the XLI. I think that won't be the case this time around. And if those lows are broken, it could lead to a bigger and wider imbalance. And notice that there isn't much support, at least to the naked eye, right? Really down till here, right? Again, it doesn't mean we're going to trade down to 37, but it certainly, all this distribution we've seen so far could weigh mightily on price, and that's enough to really push the tide. But again, it's more of the XLI, much like the euro, and the oil is much of a sort of a wait and see type of market. For next year, what to focus on? I would focus on technology, media stocks, and capital goods and banks. Those are most likely not going to be the top performing sectors. Materials and resource stocks do tend to outperform markets in an rising rate environment, but those are sort of plays reserved towards the latter end of that cycle. In other words, you don't want to buy energy and resource materials, at least not into the first or into the initial rate hike cycle. You want to again be buyers towards the end, namely because that's part of this sort of again of the cycle where they tend to perform or boast the biggest returns, but also and more importantly is because the deflationary spiral world economies and markets remain entrapped in continues to be the dominant theme, and again, oil continues to be continues to be hold hostage to that. Obviously, there's other exogenous events such as Saudi Arabia's um, sort of determination to keep production steady, to keep current market share and whatnot. But really, those are sort of the three dominating factors to as to why some of these resource and energy names will not perform as expected until later on. But really, like I said, media, technology, financials, and insurance companies, those are the ones sectors you want to focus in on. What do you want to avoid? Real estate, utilities, and transports, by and large. Those I would tend to sort of stay clear of. So that's really all I have to say. 2015, if I had to characterize it or sum it up in 4 words, it was a year of risk. It was a year of apathy, lack of conviction, and really, it was a year where what's another good word to sort of describe 2015? I wouldn't say danger because I mean, yes, there was a few sort of landmines, as I mentioned before, that you as an individual trader had to navigate through, and first of all, understand how they came about and what they mean to again sort of protect yourself and make sense of it all. But it was also a year where conventional wisdom, and I know there's not word, but not a single word, but where conventional wisdom was proven wrong. What I mean by that is that most of the things that happen for an entirely different reason than most expected. And going forward, as some of these credit crunches, such as the emerging market debt fiasco or the lingering or the widening of credit spreads, as these type of episodes and series, right, of credit crunches, um, grow more often over time, and that's partly one of the unintended. This is one of the many unintended consequences of leaving interest rates around the world at zero for longer than they should have. But in any case, as these episodes, right, grow more frequent, and they're sort of they grow wider, right? Are yeah, they grow wider, right? They're much more susceptible to price gyrations. Then it's going to become increasingly harder to navigate markets. But again, the fact that it's the only place in the world really right now where you're offered a return, some type of decent return, makes it interesting. But again, it means that you have to remain much more focused, vigilant, and again, you have to put a meaning to what it is you're doing. Otherwise, sooner rather than later, you're going to get blown up, and obviously, we all want to avoid that. So just be mindful of that. I mean, there's a bunch of other things I cannot discuss in the weekly videos. Otherwise, I was, literally spend hours. This weekly video is long as it is. Like I said, I'll be back to posting weekly videos in the first trading week of December, and hopefully by then we'll get a resolution to this trading range. Until then, happy holidays. Thank you for taking the time to watch the videos. And remember, stay nimble, respect price for what it is, and please, 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 please do not trust markets. Every week, and I mean, I see this as a really, really positive sign. Every week I get reminded of this. I cannot trust markets, and it's a good thing because it prevents me from making stupider mistakes that I otherwise would have committed if the market didn't really show me that. In fact, I can't trust the markets. But take everything in stride and pick your pockets accordingly, manage your risk accordingly, and I'll talk to you next week. Next year, excuse me. Take care.